Much, everyone. We'll move on to the next panel that is talking about ESG, and I will introduce the moderator, and the moderator will introduce the fellow panelists. So the next panel is entitled Fintech Driving ESG Initiatives Across Africa. And that panel is going to be moderated by Amanuel Alemu, who is the co-founder and managing partner of Betam Group. Amanuel, please.
Got it. Thank you. All right. Thank you, Zacharias. I just want to invite my fellow panelists up, and then I'll introduce you once you're up here. That's okay. I think Aaron wants his own entrance music. Kennedy.
Sorry, nice to meet you, Orla.
And then
yes, I've seen you on LinkedIn. No, in a good.
Okay. All right, great. Thank you for this platform to discuss this. And I can't think of any three hotter words in the market right now than Africa, Fintech, and ESG. And we have all of it in one topic here. So, and I'm joined with great panelists here. I have two founders and two investors, so we'll get a good perspective on things. So, so I'll just introduce you guys, but as I asked the first question, you guys can go a little bit deep into what you do and your roles and your companies. So Orla Enright is a co-founder and CEO at the Green Exchange, a virtual exchange for African corporate green bonds, and she's based in Accra, Ghana. We have Aaron Fu, head of growth at Catalyst Fund, and also general partner at Sherpa Ventures, which is an Africa-focused pre-seed fund. And then Kennedy Ekezie-Joseph. He's a founder and CEO at Kippa, a Nigerian fintech which builds financial management software for SMEs. And then we have Kunle Apampa. He's the director and head of client advisory and partnership at Capricorn Investment Group, and he previously led ESG and Impact unit at Goldman Sachs. And you're also an angel investor, so we'll get your perspectives in various forms. So thank you again for joining us. So obviously, when we talk about ESG from environmental, social, and governance standpoint, there's it's broad, and sometimes it can be hard to define and quantify. But depending on the type of investor you are, you'll have a certain bent to it. You might look at it from a climate perspective, you might look at it from a social angle. So just starting off with our investors, especially maybe Aaron, I can start with you. I'm curious about your approach and how you look at it from a Catalyst Fund, because you guys have one, you have a focus on how you screen your investments, and so maybe just talk to us about your approach there. And I'm also interested about how you would look at it from Sherpa Ventures, because you have a slightly different take on that as well. So maybe you can kick us off on that.
Yeah, 100%. Maybe for those of you that aren't familiar, Catalyst Fund actually does invest in Africa and LATAM and Asia. So we keep standards across the board. We invest primarily in fintech for good. And what we mean by that is fintech that's providing services to segments that are currently underserved, right? So we absolutely see that as a significant impact angle. So we measure how many people that didn't have access to quality savings products, quality insurance, and what that means for their livelihoods. But also it complements our commercial strategy as well, right? Because generally if these populations have never had access to a strong insurance product, chances are that this can be, shifting across and sort of being able to capture a large part of the market. We work a lot of our founders to help them define what impact they're delivering as well, because very often founders are sort of, commercial first and then, figuring out the impact later. And because we've seen, different pathways to create social change and to create better livelihoods and to create better resilience in the communities we worked with across these regions, we're able to sort of help them kind of, understand where they can sit and how they can best leverage their approaches there.
And Kunle, I want to bring you in at this point as well, because you helped set up the ESG and Impact unit at Goldman Sachs, and also at Capricorn. You have a certain focus there as well. And I think initially it's impact investors who are traditionally focused on screening for ESG factors. And sort of the financial returns were kind of secondary consideration. But I'm curious, is that still the case in your experience, or is it ESG is becoming integral to how investors will start looking at their risk-adjusted returns? And talk us through how that initial conversations at Goldman and transpired, and what that looks like in your current firm.
Yeah, I'm happy to be here, and good to see everyone in here, smiling faces. I think maybe I'll kick off a little bit with a very high level definition of the difference between ESG and impact, right? ESG is more of the set of criteria or framework that is really centered around financial performance. And impact investing is really around the input of some of these ESG factors to be able to produce goods and services that have positive outcomes on environment and a social angle as well. And so just high level, I know a lot of folks interchangeably use ESG and impact sometimes, but there is a differentiating factor between ESG investing and impact investing. And maybe just to layer on a little bit, you can see more of the application of ESG investing in the public markets, where you're thinking of shareholder advocacy and trying to improve sort of the ethos of those public businesses to be better for as a business, to help drive better performance for themselves. And then in the private markets is where you see more impact investing, because these are more nascent opportunity sets or solutions that people are trying to start up that have an outcome on people on planet that doesn't look at it as an afterthought, but it's integral to the due diligence process before you actually invest in it. So the question you ask is it just a fad, or has it become the way people invest? That's the message that we're trying to preach. Is I would use the example of real estate, for instance, as a very good example. If you take a look at the world's population, females make up 49.58% of the world's population. Tell me one sector that's 49.58% female dominated. None. You think of real estate, for instance, and yes, men and women working, but on average, women do spend more time in a household structure than men do. But when you're designing and developing properties, how many women actually put their input into what a house should look like and what certain appliances need to be there to be able to cater for their needs? None. Less than 2% of that whole real estate market is female, right from investors to real estate developers to construction workers to everything. And so when you think about ESG and impact investing, you're really using that lens rather than as an afterthought, more of a before thought to say, if I'm going to invest in something that's real estate specific, using this example, how am I factoring all the things that make it a little more inclusive and will drive more of a positive usage of that particular application than otherwise will? I think one of my favorite lines that I've seen so far when it comes to impact investing is like, someone said, they're Black people in the future, by the way. So when you're building solutions right now for the future, make sure it includes Black people being able to use it as well, right? I thought that was funny. And, it's a very crude way of saying that now that we know, especially with the pandemic, opening our eyes to a lot of those gaps, we should be a lot more thoughtful with the due diligence process when you're investing in sustainable solutions for the future, so that it incorporates everyone's viewpoint rather than thinking of it as an afterthought and then having the problems that we have now later on 15, 20 years from now.
I really like that anecdote from a real estate perspective, and I think it makes sense to bring in our founders in at this point, because from a fintech standpoint, I think fintech has, when you think about Africa, it's done a lot in terms of digitization and driving digitization. And then bringing in, goods and services to those that were previously excluded. So from a social angle, I think it's been a driver. And Kennedy, you have a solution, for SMEs that you've built. But talk us through sort of like your journey when it comes to the ESG angle, and did it form a core part as you were building out your business model, and what are the different factors that you're paying attention to, whether as you're setting up your own governance structure, BB, or your company structure, but also in the products and services that you offer.
Yeah. Firstly, it's really great to be here. I think on this, there's almost a sense of irony, right? We're talking about especially a market where about 80% of all investing, happens in the very early stages. So I mean, like the number of transactions, not necessarily the transaction value. And at that stage, ESG concerns and mitigating risks in that regard, it's not something that's at the forefront of the minds of investors or even founders who are trying to build. That's one thing to point out. But also just looking at the most successful companies on the continent today, think of the Dangotes and the MTNs of the world. These are companies that started out trying to solve a problem. A particular problem, that had broad sweeping structural changes for the everyday person on the continent. And off the back of that, they, became billion-dollar companies. And I think one thing that's really interesting about the market we're in, and even with earlier stage companies like Kippa, is with a lot of the fintech solutions being built, by default, you're addressing very significant social problems, right? With Kippa, for example, we have about 350,000 merchants who use our bookkeeping and payments product. And for about 80% of them, it's the first B2B SaaS product they've ever used to manage their business. A lot of them are transitioning from pen and paper, and for the first time are using a digital tool to manage their business. What that means is using automatic payment reminders on the app, they can unlock, debt from credit that's been owed to them by debtors 3 times faster. And so I think all of these are ways very early stage companies can start to try to think about how to bake that into, the core of their business model. I think there's also a second question here, like on the social side, which, I talk about with founders a lot, especially those who are building fintech in emerging markets, right? The question of answering, what are the moral limits of market, especially with pricing fintech and building solutions for the bottom billion, as it were. How do you, from day one, build a model that is moral from a pricing perspective, but that also ensures long-term sustenance of the business? And that continues to stay top of mind for us at Kippa.
Yeah, thank you. And just staying on that social theme before we go, because we're going to shift gears when we get to Orla, because we get into the climate space, right? But just staying in the social aspect, Aaron, maybe I can ask you this, because you look at in different markets, as you said, what are the enabling factors that you see maybe in LATAM and in Asia when it comes to fintech, and really addressing like social issues and kind of innovations that you see elsewhere that you perhaps don't see or you would like to see in Africa, and what are the enabling factors that allow them to do that? And thinking about Africa, it's not homogeneous, right? So like, when you think about the different markets within Africa, what are the enabling factors that allow either Kippa and others to succeed?
Yeah, no, great question. I think like before I dive into that, I think something that Kennedy said really resonated with me was by building a moral model, you're also building a model that's longer term. Yep. You're building a model that is truly catering to the needs of your customers in a very holistic manner, right? Turaco, which won the InsurTech Award recently, we've been working with them for years. And one thing that's very top of mind for Ted is he wants to see claim rates consistently high, right? Which is very counterintuitive from an insurance company, because you kind of want to depress claim rates. But like, there's a way of looking at the model that says, actually, I want claim rates to be super high because I want my InsurTech to be known as the InsurTech that pays out the most claims. And that gives them a great long-term advantage, right? So I think he's obviously guided by his own Christian principles, and I think he definitely wants to see more people get paid out. But there is an interesting sort of overlap between building a right social model and then sort of building the right model for your customers too. Thinking about sort of cross-regional model transplantation, I actually think there's a lot that Africa is doing, around, PAYGO that I think Mexico can learn a lot from, that LATAM can learn a lot from, that those models are slightly beginning to emerge. So that level of, trust that these manufacturers and these intermediaries are giving. On the flip side, some models that I've seen in Asia, for example, around digitizing group insurance, right? There's a really cool sort of like Chinese startup where, almost savings collective groups can kind of get together to define their own insurance policies triggered by X, defining their own payouts, defining who gets to claim over what period of time, and everyone sort of contributes to it, right? So I would love to see sort of like more African models that, develop more customization, right? Using digital tools, but allowing communities to define what's right for them, what's appropriate for them, and what they really, really want to use as well. So I think sort of the standardization of like the one product across African markets is not the right one. And certainly, what is right from a social good perspective in Senegal might not be right in Kenya as well, because the needs of communities are just so different.
Yeah, the needs and the culture needs to be paid attention to. That's a great point. And just kind of shifting gears into the E part, when it comes to climate finance and sustainability, I think the debt markets have sort of been the leader in that, and the green bond and sustainability linked bonds have, I think like I forget the stats, was almost 100 times bigger over a decade. And you're in that space. Why don't you talk to us about the solution that you've built and what you're seeing in the market and what the problem that you're trying to solve is.
Yeah, sure. So thank you very much for having me. So what I've built out is what my team and I should say is built out as is something called the Green Exchange. So what we do at the Green Exchange is we facilitate the issuance of corporate green bonds in Africa. So we've decided to tackle this problem because, to be frank, the problem is so large. So Africa is always going to be the continent most affected by climate change and the risks of a warmer planet, just because of its geographical positioning, reliance on natural resources. But then you have to couple that with also the fact that Africa is always going to be the continent that is the most isolated by financing historically. So then what you're left with is a debt market in Africa for corporate green bonds, which is untapped. I can say with quite a lot of confidence. There was 12 green bonds issued in the entire continent, and there's been hundreds of thousands issued globally. So if you really think about that figure, and you can think about how substantial that is for a continent that is the most affected by climate change, you can see how bad this issue is. So Africa contributes 0.2% of corporate bonds, corporate green bonds, I should say. So what we're building out at the Green Exchange is a platform that will facilitate the issuance of corporate green bonds. So I've got a deal team on the ground in Accra who work with companies, established companies, I should say, to get them into a position where they can issue a green bond that can then go for issuance and then get verified as green. So that's one side of it. And on the other side is we facilitate the investment into green bonds. So you get a lot of DFIs globally, in Europe and as well as in America, that are really eager to diversify their portfolio into investing into more green bonds, and specifically in Africa, but they just do not have the opportunity to invest in corporate African green bonds. So we work with the DFIs to facilitate their investment into these green bonds. So the typical green bond side we see is between $20 million to $100 million. The real sweet spot though is, I'd say, through R&D, I'd say between 20 to 60, because the African green bond market is very much in its infancy still. So what our mission is to drive climate capital in the US, Scandinavia, even in London, even though they are quite conservative with capital, but that's another story, into Africa to mitigate the risks of a warmer planet. And we want to utilize green bonds. Green bonds are the most transparent form of financing for climate issues. And it's an excellent tool to mitigate the risks of a warmer planet. Yeah, that's it. I was in venture capital, I should add, for the last 4 years in Ghana, and I was backing pre-seed and seed fintech. So Zipe, I don't know, you guys probably know it. Yeah, Zipe in Ghana. So 80% of the deal flow I saw across Ghana and London was fintech. I didn't see one climate tech in Africa in 4 years. So I think that speaks volumes to the issue. I'll probably end on that note, actually. It's probably the biggest.
And just staying with you there, and in terms of the projects that you're seeing in your pipeline, are these just basically, you know, solar farms or wind farms, or, you know, give us a sense of the kind of projects that you're seeing through your platform?
Yeah, that's a great question. So they vary. So I'd say the most popular form is actually building sustainable housing. So as a successful corporate green bond issued in Nairobi, backed by Acorn Holdings, insured by Standard Bank, that was for student housing, I think just outside of Nairobi, but it was sustainable. But yeah, the projects I see that are backed by corporates on the ground are, yep, like you said, wind turbines, solar panels. There was a tea tree plant that I was speaking with yesterday, actually in DC. A company in DC and Accra wants to issue one. But yeah, the thing with green bonds is you have to get verified by a third party to make a bond green. So it has to be backed by the Climate Bonds Initiative. So you have to be completely sure that the funds that you raise for this green bond are actually mitigating the risks of a warmer planet, and they are tangibly giving back to the environment. So it's not always easy to prove that a bond is green. So yeah, I'm trying to think of more examples just for the benefit of the audience. So yeah, wind turbines, solar panels. We saw a brick factory. So typically bricks are obviously made with concrete, but you can make them more sustainable when you're building them with clay. That's another example. Yeah, a lot of agriculture. So like tree growth, plant growth, some tear gas removal plans as well, things that can lower carbon emissions. Yeah, like quite a large range. I hope that gives you a good idea.
Absolutely, and I'm encouraged by the diversity of the projects, and I think that you know, your platform can really enable more of that across the continent. Kunle, coming back to you, you know, when you and I spoke, you were mentioning about your approach because you're also an angel investor. So talk us through like how you think about, you know, ESG indicators, and what are the ones that you are focused on as an angel investor? Because, you know, by nature of being an angel investor, you're coming in very early on, and some of these startups might not even have thought about some of these factors. So give us an indication of what you look at, and, you know, do you help them through the process as well?
Yeah, when I think impact and I look at Africa, it just screams impact squared to me. And I think a lot of global investors historically have just ignored funding for Africa just because they don't understand the intricacies associated with Africa holistically. I view the world of ESG and impact through 9 thematic lenses, 5 of them on the climate, 4 on the social. On the climate side, clean energy, sustainable transport, sustainable food and agriculture, ecosystem services, waste and materials. And on the social side, education, healthcare, financial inclusion, and communities. And when you think about fintech specifically, I think of financial inclusion, right? You're bringing a group that has probably been historically marginalized from getting access to credit or getting access to financial products, and you're building sort of businesses that are either tech enabled or otherwise to be able to alleviate that problem or close the gap that exists. I do enjoy being an angel investor, and I think that's what even brought me to this conference in itself, because I'm leveraging the work that I've done in impact and in ESG to look at Africa, because there's the term, you can't improve what you're not measuring. And when you look at impact in Africa, a lot of businesses already have impact embedded in there. They just don't know how to measure it. And so when I look at my investments from an angel perspective, it's really trying to help these companies that already have impact inherently embedded in their goods and services, in the way they operate, and helping them think of the impact metrics that they can measure over time. My goal is that, you know, you make these investments and you look back 5, 10 years from now, and you're able to see the progression from an impact perspective, how many lives you've touched, how many people's lives have changed as a result of your business. And so one of the criteria that I have for my own specific angel investing is my portfolio companies working with another company that I invested in that does sustainability consulting. it helps them build impact reports, right? So you sit down with them for 4 to 5 months, understanding the key metrics that drive your business from an impact standpoint. And when you deliver back to your investors, you're delivering 2 bottom lines, the financial return and the impact return as well. And so when I invest in a lot of companies in Africa, and they could spin out from fintech to insurtech, agtech, health tech, and these various different variations of what I would consider using technology, fintech to solve problems, I'm really focused on making sure that it's measurable and it's tangible. Not only that, helping African companies think about impact through this lens gives them a great entry point into the US capital market. A lot of my portfolio companies have gotten great traction because when I tell them you show up with 3 things, your 1-pager executive summary, your pitch deck, and your sustainability report, 9 times out of 10, they get a call back from whatever VC or PE firm they're talking to, especially if they're impact or mission aligned as well. And so my focus is trying to really, and understanding my space in the ecosystem, I'm really just trying to be a bridge between risk-adjusted returns and opportunities that exist on the continent and will otherwise not have the access and network to opportunities here in the US. And I'm trying to be that bridge between connecting these 2 opportunities so that Africa can continue to receive the much needed funding that it is and needs to be able to sustain. A lot of people in North America, when they talk about clean energy and solutions, they say we're trying to save the planet, and then they forget about Africa. And I tell them, you can't think of saving the globe if Africa is not coming along. And so that's the message that I hope to continue to preach, is helping folks really understand that we all need to do this collectively together to be able to solve whatever big problem that we're having holistically.
Yeah,
I'll just add very quickly to that and say, divorced from your business model, impact metrics are very hard to measure. Like, if they are not a core part of your business, right? I'm on the governance committee for a Fortune 500 company that invests 50 million euros annually into CSR. But just because it's not the core of what their business is, there's a very tenuous link between their business and CSR, right? There's improper allocation of capital to whatever seems hot at the time. So, COVID is happening now. Let's throw in all our budget this year into that. It's Ukraine this time. And I think that's the thread that we're seeing. But secondly, especially, given the context I laid out earlier, for a continent where a lot of the investment is happening at the very early stages, again, divorced from your business model, can imagine how horrendous it will be for an early stage founder to have to worry about that outside of your business model, right? To maybe start to do things like carbon credits and to offset the carbon footprint of your members of your employee and staff strength. It's expensive, it's time consuming. You really have to spend a lot of time thinking about the way to do that. And so, I think the good thing about the market we're in is a lot of the problems, the social problems present themselves as opportunities that companies are being built around. And for most people, just by taking one of those and building financial technologies to solve those problems, it's ingrained in the business model, and all of these consents don't have to externally exist.
Mm-hmm. No, thank you for that context. Did you want to add something, Eric?
Yeah, no, maybe just quickly, it definitely sounds like there needs to be a lot of education out there, both, I guess, on the founder side as well as on the investor side. When we first back companies, we spend the first 6 months really helping them measure their impact, doing it for them almost, and then producing these reports, as Kunle was saying, taking that to investors and getting the reactions, right? And I think when some of these founders start to understand the possibilities of capital that they can access as a result of measuring these things, they end up doing more of it and measuring more of it. And then on the investor side, we spend a lot of time educating investors on, we get a lot of pushback. So for example, we backed Cowrie Rise in Nigeria, sort of similar to PiggyVest, but yeah, different. And one big pushback we got from impact investors is that, their primary target customer is sort of middle class to sort of upper middle class, where they want to access sort of, more complicated instruments. How is this impact? How is this inclusion, right? But they do have a good, 10-15% of their total customer base, which are sort of like low income groups with no access to savings. But obviously, why won't I back another company that is exclusively helping that segment save, right? As opposed to backing a more diverse company. So, Kariwise definitely doesn't see impact as core to what they do, but certainly now with our help, we've generated all these reports with them, shared it with a bunch of investors. Like it's a lot more interesting to see your impact dollars match with commercial dollars and then really scale, right? So we're definitely like big proponents of seeing that happen.
Yeah, no, and just along the same lines, I'm just curious because there's no real standardization across what people would consider inclusion, like you were mentioning, right? And so as you're telling the story, and with all the VCs that are now increasingly being more focused on ESG, how do you navigate that? Because then, are you having to write like multiple reports for like different target, and what are your conversations with LPs like when you when you have a conversation with them about your funds? And I'll just throw it out to Kunle and Aaron, but also I want to hear from the founders as well. Like as you're conversing with potential investors, is one person's definition or one fund's definition, it differs from another. So like, how are you navigating these conversations as they become more and more central?
Founders want to start? You want me to start?
You can go ahead. Yeah.
Yeah. It's tough because as an industry, especially when you talk about impact investing, it's still pretty nascent from a standardization perspective. Like the example I like to use is the derivatives market has ISDA, and ISDA has defined taxonomy for that entire industry. We don't have that in asset management when it comes to impact investing. And so when I say catalytic capital, there's like 10 different variations of that definition that I could get from 10 different people. Or I say impact investing. Some people look at it through the E lens. Some people look at it through the S lens, right? Not to say that any of this is wrong, but I am optimistic that we will start to see an emergence of market leaders that start to define these taxonomies and people supporting that definition. You talked about carbon credits, for instance. If you talk to Generation, they have a way of calculating carbon emission, CO2, which is completely different from if you talk to energy impact partners. And that disproportionate measurement causes a lot of problems for investors who are trying to compare things apples to apples, right? And so things like the SEC coming out with regulation or proposal of regulation for carbon accounting on US public companies is one step forward to how we can start to standardize carbon accounting for one. That way, when you're doing your diligence, you don't have to have an overlay for one specific sector versus the other. But I'm optimistic for Africa specifically in being able to view impact, not just through the lens of we're helping people or these are the people we're trying to help, but also ingraining it in sense of how they're building their business holistically and being able to view through that lens, the lives that they're touching, but how their business model affects overall growth of sustainable solutions that the continent is looking for. Yeah,
maybe one of the founders can receive.
Yeah, I mean, like just from personal experience with talking to investors and you're bringing them around the table. I think for some companies, depending on what you're building, the conversation is shorter than others. The link, for example, with a company like ours is a lot stronger and almost intuitive to understand how that directly contributes to like the social impact overall. But I think for others, I've seen it also depends on how the story is told. And for example, taking the Kariwise example, I think it is, there are many ways it can be looked at that, the act of taking a country's middle class, strengthening them, unlocking access to more products for them is a net social good, on a long enough time scale. And I strongly believe that. And again, I think with a non-sophisticated, looking at it from a non-sophisticated lens, it's, okay, yeah, like you directly need to be serving these people who are at the bottom of the pyramid. But I think that's another angle, strengthening the middle class is a social good. And, companies doing that should still, be rewarded for doing so. And so, yeah, I think it's storytelling and, like, conviction, the amount of conviction that founders have, in the long-term impact of the businesses that they're building.
Orla, you had something?
Yeah, I'll just add on that. I think in my experience, so when I've been dealing with the DFIs, it seems to be the case that they care far more about seeing tangible good return on the investors. So they want carbon credits, for example, especially if they're investing in a green bond. Whereas when I'm dealing with venture capitalists, or when I was even a venture capitalist, personally, it wasn't at the top of my agenda, maybe because it was 3-4 years ago. ESG wasn't as hot as it is now. Obviously, now it's at the top of everyone's agenda. I do think greenwashing is a real issue in the startup world. I remember a fintech pitched to us with their green angle, and their green angle was that they didn't use receipts because it was a fintech. So they were reducing paper. I was like, okay, if that's a green startup, then fair play. I thought it was quite smart, actually. Thought of it on the spot, clearly. So yeah, I think it very much depends on the VC. Every investor's different. There's some very specific climate VC funds that really need to see tangible doing good, especially with green bonds. It has to be specific. What are you giving back to the environment? How are you reducing the climate change? How are you reducing the effects of a warmer planet? I hope my answer is clear enough. I think I've gone around the houses a little bit though. But yeah, DFI is super tangible. You need to show how you've returned. VCs, sorry, typically not that much. In my experience, anyway.
Your response to that, Aaron?
I will, but because of your example, actually at the Africa Fintech Summit in Cairo very recently, there was someone in the audience who's startup as well who was saying, our startup pays workers directly through more money. They no longer need to go to the bank. So therefore, we are computing the carbon emissions of their trip to the bank as our offset and our contribution to, I was like, you can, I guess, that's a stretch. So people are getting creative with it.
Yeah.
But the point I did want to touch upon is maybe operationally two responses. One is, yes, currently we create very different reports for each one of our LPs, each one of our funders, because they do need very different things. Two is, in the long term, we definitely try and get more of our LPs and funders in the same room, having the same discussion to try and get them a little bit more aligned on what they want to see in the world and what they want to back and just their worldview, right? And I think, unfortunately, the onus is on us to drive those conversations with them and to help them see how difficult they're making their lives right now, right? And I think there's a lot of promise in getting. I think they want to align. But I just think there needs to be more structures to push them along that way.
Yeah.
I do want to add very quickly, when we talk about ESG, people very, very quickly forget about the G, which is the governance. And I think
I was going to ask that question, but
yeah. And I think even within ESG, we still need more of the G to define ESG in itself, right? And that's what everyone is alluding to. If there's proper governance and there's proper structure on how you actually measure these things. By the way, creating an impact report is not any small feat, by the way. I did this for 6.5 billion advisory assets across 21 mandates, and they were all customized to their own specific portfolio, which means I had to compile over 500 different impact metrics, roll it up from portfolio company to fund to that customized fund of one structure. That was a lot of work. That took about 10 months of work to do. And so you mentioned it, it's very, very difficult to measure, but that is the work that I'm embarking on too when I look at Africa is what is that difficult work that nobody else wants to do? How can I use that to translate it in something, data that makes sense and tells a story? And then how can we go to global investors and tell them that African story through an angle that they can easily recognize? And I think that's what a lot of us on this panel are trying to do and trying to expose to the rest of the folks out there.
And I think just summarizing this discussion that we just had around this topic, I think one takeaway is it's never too early to think about the ESG aspect, and the storytelling is really where it's at in terms of making sure that you have that understanding that's built in across the ecosystem. So I think we have maybe time for one or so audience question. Two, okay. Do we have a mic or? Okay, back there, I think, yeah.
Okay, yes, sure. Here's Jordan Howard,
Push up. Here we go.
I'm Darnley Howard, Advanced International Financial and Management Consultant. Question is getting, again, to this point of impact measurement. To what extent are companies and investors making use of things like the IRIS standard that the Global Impact Investor Network uses? They have a long, fairly elaborate one that I've studied a lot and starting to use in my practice because it also helps to match to the SDGs, which seems to make a lot of sense for international and for international investments, for African ventures and others. So I'm just wondering to what extent people are actually making use of it.
Full extent. Capricorn is one of the co-founders of GIN when they started back in 2008, and I'm leveraging a lot of that network and that access to, PRI framework, UN SDG goals, GIN, the Impact Investing Network. I'm leveraging a lot of that resource to try to help, African founders and startups who ordinarily wouldn't get those sort of materials just readily available, but also tailoring it to the African market, because the lens that you look at impact investing for the US is not necessarily translatable to Africa in itself, right? And so, yes, to answer your question very directly, yes, a lot of those inputs, a lot of those resources from GIN and the rest alike, we're definitely using that to be able to look through the lens of impact investing for Africa.
I guess the message is there's no, you don't have to reinvent the wheel. There's already resources out there. Yeah, one more question.
What you just said, I noticed a fintech conference, but biotech, healthcare, SDG, right? What are you guys looking through the lens of these impact measurements? Because I have a company, Indigenous AI, who's trying to build capacity on the continent. And as you can imagine, Silicon Valley is not interested in building capacity on the continent. So how are you guys using that impact investment tool or measurement to look at, again, Africa being under the age 30 is the average age, of making sure that workforce stays healthy for the next, 50, 60 years, because that's an area that I think seems to get missed in the investment areas. I mean, folks in Africa knows healthcare system, but the innovation is the tech, which feeds into what you guys are doing on the fintech side. So wanted to hear how you guys are approaching bridging those two gaps, because there is economic incentives of keeping people healthy to work longer and live longer.
My super quick response, I'm sure Kunle has much more. I think fintech has a huge role to play with regards to increasing the health of the workforce and the population in Africa for sure. And because I think a large part of why the health system is broken is around the financing of health, right? Financing of access to drugs, financing of care, primary care. It's tough, right? So this is not an embedded fintech panel, but I will say that we're very excited to continue to back solutions that help on that front, right? Payment systems around hospitals and clinics, financing of equipment in the hospitals. So we by no means understand biotech by far, but we understand the financing of it, and that's where we see where we play.
I'll answer with an example of one you could take back, and Sam is not here, but Flery Health. Please, if you remember that name, talk to Sam. He's here at the conference. Flery essentially took the remittance business, extracted the value out by saying, why do you send money back home? Top thing was medical. Then they went back home to the people who got the money. What do you actually use the money on? Jaye, food, or everything else. And the medical was like the last thing that they actually spent the money on. And so why get all these added costs doing remittance business? Why don't we extract the value out, build an insurance tech business where folks like myself in the diaspora, I'm a policy holder, so I'm also a user. I pay $30 a month for each of my parents. They're on the Flery healthcare plan. What do they get on the other end? They're beneficiaries of the insurance policy. So Flery has built a network of hospitals, pharmacies, HMOs on the continent in Ghana and Nigeria, and they can reach anyone, anywhere based on that partnership model that they've built. It gives me peace of mind knowing that once a month, there's a healthcare representative that does a full medical checkup on my parents and then makes a recommendation on what hospital or specialist they need to go to, rather than them just feeling a certain type of way, hesitating that they don't want to go to the hospital, waiting 2 years and then realizing that the problem is a little too late to solve at that moment. So that's just an example of redefining the usage of technology, insurance, healthcare to try to solve a lot of the problems on the continent that we have.
Yeah, and that's a awesome example. And I think the takeaway from all this is, one, like fintech still has a role in terms of shaping and driving a lot of the necessary innovations that needs to happen across the different sectors, and enabling that, be it through the remittances that you mentioned, or insurance and things like that. So definitely an exciting space to be in, and we can talk about this until until the happy hour and post, but unfortunately we had to wrap up. But I do want to thank each one of you for your perspectives, and invite everyone to kind of grab them and have a conversation post this. So with that, thank you.
Thank you.
Thank you very much. Thank you very much for this engaging and interesting panel. Very much appreciated. So Kunle mentioned about Flurry earlier on, and Flurry is one of the startup companies speaking later on. So you can catch up and then read and listen to their story later on. Now we'll be shifting gear to Metaverse, NFT, and Web3. So we have two interesting fireside chat from the theoretical and thought leadership point of view. What is Metaverse? What is NFT? And what is its role in Africa? And we will also have another follow-up fireside chat about the investors